Thanks for clicking. As the Russian-Ukraine conflict continues to intensify, the Bank of Montreal released a report on Sunday looking at how the current crisis could affect the Canadian real estate market. The report says that unlike international crises in 2014 and 2020, the invasion of Crimea and the pandemic, what a time, we should not be expecting to see a rise in house prices as a result of the Russian invasion. So what I want to do today is go over the report as it outlines 3 key reasons why this time will be different than previous wars, previous international crises, which essentially juiced up the price of Canadian real estate. And it's likely that this war will actually be bad for the Canadian real estate prices. We're still expecting to get Canada's real estate data out for the month of February, which should give us a much better idea of where the market stands vis-a-vis the whole entire country. And we're also expecting to get the inflation data out next week, which should give us a much better idea of where the Bank of Canada will be standing vis-a-vis its next rate announcement. Click like and subscribe if you want to get those updates, but for now, let's get into this report. First and foremost, BMO argues that the Bank of Canada does not see the war as an obstacle to rate hikes. Though the Bank of Canada Governor Tiff Macklem said the bank will be proceeding with caution as the war unfolds, the report says that caution will be sorely tested if inflation continues to go up higher than the current 3 decades high inflation of 5.1%. With many predicting that the inflation rate will be higher than we had previously anticipated, the report argues that the Bank of Canada will not have a choice. As inflation goes higher and higher, the Bank of Canada will have to raise interest rates.
I gotta do it, man.
Even before the invasion, many had predicted that the Bank of Canada would be raising rates between 6 and 8%, and that was before we got to sky-high oil prices, which we're about to talk about. With oil at a 13-year high, highest since the 2008 financial crisis, and wheat at a 14-year high, it's likely that sooner rather than later, these higher inputs will eat into our inflation rate. We will start to see the price of goods go even higher, not just at the pump, but everything that pump uses to transport. Our food prices, everything is about to get even higher at a time when our inflation rate was already at a 3 decades high. Given the inflation that we've already had over the past few months and the inflation that we are no doubt about to encounter, the report notes that Tiff Macklem hasn't ruled out a 50 basis point rate hike. So last week we had a 25 basis point rate hike, that's 0.25%. This report argues that we could be in for another 50 basis point rate hike sometime in the near future in order to cool down the inflation that we're no doubt likely to see from the increased price of oil and the increased price of wheat. And the argument being put forward here by BMO is that we already had 3-decade high inflation, and it's about to get much worse because of this invasion of Ukraine and the impending rise in oil prices and the impending rise in wheat prices, which will impact our food prices. Because of these high inflation rates, the Bank of Canada will be forced to raise rates much higher, much faster than had previously anticipated.
You have no choice.
Very similar to the 1970s, and we've talked about this before, when you have an external event, not the normal ups and downs of the market. You have an exogenous shock to our market, a much, much higher price of oil. Our inflation rate is set to go sky high because of it. With the sky high inflation, we're going to have the Bank of Canada is going to have to step in, and they're going to have to raise rates to such a point that it will impact the real estate market. Finally, ever the optimist, BMO argues that it's hard to imagine Canada's real estate market getting any worse.
Can't get any worse. Yeah, Sweet Pea, it can.
New reports out showed that Vancouver's year-over-year price had risen 20.7%, with Toronto's rising 35.9%, and London's up 41.9%. In a balanced market, according to BMO, these should be at about 4.5%. Given the high inflation rate that we've had, the increased pressures brought on from the inflation by the war, it will not take much for many of these cities to slow in the coming months. Because the housing prices are so high in these cities, because the price of houses have ramped up so much, so fast, any increase in the cost of borrowing could cause a very quick reversal, and this report argues that real estate investors who have been growing their share of Canada's real estate market will likely be the first ones to exit. The report isn't specific as to why they think the real estate investors will be the first ones to exit, but I assume it would be because of higher cost of borrowing, and as interest rates rise, investors will find better places to park their money. So to summarize, because of the high price of oil, because of the high price of wheat, and because we already had high inflation, the central banks, the Bank of Canada, the US Federal Reserve, are going to have to jump in to get a hold of this inflation rate sooner rather than later, and they're probably going to have to move fast. When they move fast, when they move soon, it's going to put downward pressure on our real estate market. The cost of borrowing on real estate is going to get much, much more expensive. And with prices already so high, affordability becomes a real concern. If rates go high fast, this report is arguing that this is going to have a real impact on our real estate market. So, with inflation already at 5.1%, with some even in the US expecting that the US inflation rate to rise above 8%, which gets announced on Thursday, the increase in our inflation rate doesn't seem to have an end in sight, which could get even worse if Canada bans the import of Russian oil. Whether or not they are going to ban that oil remains to be seen, but obviously we should find out in the next coming days and weeks ahead as this war unfolds, unfortunately. We will have updates out on the actions of the central banks vis-a-vis this war, on the inflation rate, and obviously what this is doing to Canada's real estate market. If you want to get those updates, make sure you click like and subscribe, and thanks so much for watching.